Before diving deep into the financials and operational side of the business, you're going to need to conduct a basic research process to assess whether a business that you're looking at is worth pursuing further. That's what this section is going to cover. This stage is going to help you either quickly eliminate businesses that don't meet your criteria or decide that you're going to move forward. So, what is it that we review? When you look at listings, here's a key checklist of things that we're going to look at, and I'm going to talk a little bit about each one. When you review each business listing that you're potentially interested in and it passes your first gut check, you want to really look beyond the surface details like revenue and asking price. You want to focus on the following, and here they are. The first is business description. And this is going to tell you what the business does, its market position, and the primary products or services that it offers. Reason for sale. You want to investigate why the owner is selling. Common reasons might include a retirement, health issues, or moving on to just do something else. You want to be cautious of businesses that are being sold due to declining performance and because they're just a mess for the owner to manage, and they want to get rid of it as fast as they can. Location and market conditions. Consider how the business's location impacts its success. Is it a growing area? Does it rely heavily on foot traffic? Or are the regional trends in play? Key financial data. Most listings provide basic financial information such as annual revenue, cash flow, and profit margins. You want to definitely use this as a starting point to determine whether the business meets your financial goals. And the fifth point that I want you to consider is length of time in business. You want to look for where there are established businesses that have a proven track record of success, because generally these are going to be less risky. Newer businesses could offer more growth potential, but at a lower purchase price. As the saying goes, you want to pay more for a really good business than buy something riskier. In addition, you also want to begin to think of the key questions that you want to ask and get answers to. Once you find the business, you need to clarify some things that are really important to you and to this deal. So I have just a list of some examples here, and let's go through them. You want to ask, what are the biggest challenges the business is currently facing? You want to understand if this is something that is low stress and low pressure, or is this is something that's passive that kind of manages itself? How involved is the owner in day-to-day operations? This is super important because if the owner is a key employee, well, you're going to have to replace them. That costs time and money. What growth opportunities does the business have? Is the business able to grow? Has it proven that it can grow in all sorts of economic situations? Or is this a business that just is in its first cycle and is unproven? Are there any outstanding legal or regulatory issues? This is super important because this talks about the reputation that the business has and the risk that may be hidden. And what you want to do when you ask these questions is to dive deeper and feel out whether the deal still matches your perceived implications of what's going on, or if this is now outside the scope of where you're comfortable. And you want to talk as well about what are the key factors that have driven this business's success. You want to understand what the secret sauce is that makes this business so special and so valuable and worth having as an asset. Next, we want to turn to the financials and some quantitative measures. Here's some things that I highly recommend you look at. The first, of course, is revenue. You want to look at the company's top-line revenue over the last 3 to 5 years at a minimum. And you want to ask, has the revenue been consistent? Has it grown? Has it declined? And does, more importantly, the story match up to why this has happened? You're going to ask why the revenue has gone up or down, and sometimes the story can be really flaky. They can just say the economy or something else that really they should have more control over, and it's going to show how strong or weak the business is. Consistent revenue is such a positive and important sign, while declining revenue could indicate underlying problems that are going to take longer to reveal themselves. Recurring revenue is something that you're going to want to look for as well. Many business acquirers very much value recurring revenue because these types of businesses with subscription-based models tend to be more stable and less risky than businesses reliant on one-off projects or sales. If you have a client that pays in full every time, every month for years, that's incredible, and you can plan that's going to keep on going. But if you have to constantly dig up new projects that don't always convert from lead to sale successfully, that's just going to add more risk to what you're looking at here. If you're comfortable doing that, that's great, but you need to understand if this is something that's one-off or something that's going to be recurring. Next up, I want you to consider the profit margin. Right after revenue, this is going to be number 2 for you, because profit margins tell you how much of the revenue is left after all the expenses are paid. And it's important here to look at both the gross profit margin, which is revenue minus cost of goods sold, and net profit margin, which is represented as net income as a percentage of revenue. And what this is going to tell you is that higher margins will indicate a more efficient and effective business. And of course, what you want to do is also compare the margins to industry averages to ensure the business is at least competitive when you benchmark it. Some industries just aren't that profitable, but they do enough volume of business where they still make plenty of profit at the end of the day. Whereas other industries are highly profitable, but they might do less in sales. So you need to understand what you're getting into and whether things are as they should be. One of the most important pieces of looking at a deal is cash flow. And this is critical because, as they say, cash is king. Positive cash flow is a crucial day-to-day operations indicator of the health of the business. It's true that a business can be profitable, but it can actually be losing cash just because of the cycle of how things are working out. And you could lose the business because you don't have enough cash coming in, even though you're showing daily, weekly, monthly profits. It's true. So what you want to do is evaluate the company's operating cash flow to ensure it has sufficient liquidity to cover expenses and reinvest back in the business. You also want to look for cash flow stability. And this is where you want to review cash flow trends over time to ensure there are no significant fluctuations that could indicate, say, a seasonal dependency or serious cash management issues. If there are those ups and downs, you need to understand where they are, why they occur, and how they're managed. The final key financial metric that I'm going to ask you to consider is the debt level that the business has. You want to assess and look at the company's current balance sheet to understand what level of debt is required to manage this business. While you may not take on that same debt, you're going to have to add new debt to this business, and you need to understand for every sale how many dollars of debt are required to get things up and running. And this is going to tell you if the business is healthy, whether it's sustainable or unsustainable. And then there's a few metrics that you can compute to tell you whether the level of debt to sales and profit is healthy. One of the most important ones is the debt to equity ratio. And this is going to compare for you the company's total debt to its equity. And this is going to help you understand how leveraged a business is and needs to be to survive. A high ratio is going to signal financial risk that you may not be comfortable with. Of course, with liabilities, you want to check for any outstanding liabilities such as unpaid taxes, loans, or pending lawsuits that could impact the business post-sale. In some ways that the deals are done, whether it's a stock or asset sale, those liabilities could come with you, especially if you do the stock sale. So you need to be sure that things aren't going to come back and bite you in the butt. Even if you do an asset sale, if there's pending lawsuits or a bad word of mouth about the business in the community, even though it's not a liability on the financial side, it's still going to affect how the business's performance goes in the future.